Hi everybody, my name is Adam Meyer. We're going to go over today what Elon Musk is doing with Twitter and also why the markets just fell based on what the Fed just said. So let's get into this here. So as some of you might know, Elon Musk actually bought 9% of the Twitter stock. So that's how much he holds. He's the #1 biggest holder within Twitter itself. He actually just got appointed to the board of directors for Twitter. So that means he can vote on like the dividends. He can vote on like hiring and firing of other positions. And he's basically there for the shareholders of the company to make it a better place all around. And what he wants free speech, and he wants other organizations, other big businesses to focus more on Twitter and not have to worry about just like getting stuff deleted or whatnot and having too much regulation, especially for individuals like influencers like himself. As we all know, he does a lot with Tesla. He's grew this company to be huge. SpaceX, PayPal, all this stuff. So I have a lot of faith in him with Twitter. So for me, what does this mean for me investing wise? For me, I might be buying some Twitter when we have pullbacks in the market. So that's why I'm going to incorporate the Fed into this video, because it's actually going to talk about some of my buying points for overall in the investing market. So going over here to this article, they said that Musk will be a passionate believer and intense critic of like the whole space. He won't be allowed to own more than 14.9% of the common stock. He owns a little over 9%, like I said before, and he cares deeply about the planet and Twitter. So that's really what we care about with that. And also, if you want more information here on the board of directors, I'll link this down in the bio below. You can just read a little bit more of the quick video here based on what it is and what it can do for a company and why all these public companies need to have them to vote on the shareholders' behalf. So let's go over here to the Fibonacci retracement on Twitter. And as we can tell, the overall market did sell off, as we talked about in the previous videos. And we did come down to the 79 to 62% retracement. And this is where we consolidated. Musk actually bought the dip, which is crazy. Over here on March 14th is the day he bought it exactly. So he bought the dip. So whatever he put in there, he's already up 60% of what he had. Crazy. Billionaire making billions of dollars just off this. So you gotta love it. And good for him. He deserves it. But we can look to buy this to take up with him. So what did we see? We saw the market had a pretty massive gap once the world found out he actually bought this. So we gapped up a good like 17% or so. So if we look to get like fills and orders, because there's open orders still sitting in there, the banks might want to come take that back before actually coming back up higher. So for me to want to buy Twitter myself, I'm going to be looking down lower into here to then buy up into those ranges. So now let's get into why the market fell today. Let's actually get into the technicals first to what actually happened to the chart. We were looking for a price to buy up somewhere up into this range, but we actually became very, very bearish today. There's a lot of interest rate hikes, more talk about them, how they might come in faster than expected compared to 2018, because originally Jerome Powell said he was going to mimic very similar to 2018 about how they raised their rates, but this time around they said they might be going a little faster. So the market didn't take that too nicely. To me, it's not that big of a deal because it's not really going to affect us like right away. And also, I think the market's just having an overreaction. So this might be another buy the dip opportunity. We might be actually dipping some more on actually this higher time frame to come more down in this range before buying up. That's why we've had a massive sell-off today. Based on the fundamental news, that's not technical wise. Technical wise, the banks are going to bring it down anyway. But just based on the news, it drove the market down over 2% today. All right, the last thing I'm going to bring up here is the last time they've raised the rates. So this is very interesting, so pay attention to this. So back in 2004, 2005, this is where they rose the rates. And then this is where it fell off. They started lowering it back in like 2007 and 8. So the market didn't actually crash through 2008. And if we go over to the NASDAQ market, we can see this is what happened over here. As you can tell, the crash in 2008 was over within this range. And this is where we started to fall, 2007, 2008. But as you can tell, they were raising their rates all the way up to this point. So this is November 2007, basically where we peaked, October, November. So if we go back over to this chart, October, November 2007. October, November, this is where they started decreasing their rates. So as of right now, we are just starting out, and then this is where the recession came in after. If we go look actually at where they started raising rates again, over here in 2015, and then here's 2019 over there. So if we go over to 2015, let's fast forward over to here. So 2015, right over here, we go. We're going. This is where they're raising the rates. And this is actually where we start to see the fall. Back in December 2018, so almost 2019, that's where we see that fall. So if we look over here, this is where it started to peak. So what we've been seeing in the past two like big recessions besides the COVID one, we've seen that the market falls at the peak of their rate hikes. So what happens now? Right now, we're just seeing the rate hikes starting, and this can mean we might not be seeing a fall in the market. So we might not actually see this entire market fall now just because of rate hikes. So if you guys have any questions, you can reach out to me, join the Discord, and thank you very much. Take care.